I'm going to call to order the Joint Retirement Investment Board regular meeting, December 3rd. It's 7:08 p.m. I think the first order of business is to approve the minutes from October 22nd. Has everybody had a chance to take a peek at those and make sure they're all kosher? Okay, anybody like to make a motion?
I'll make a motion to approve.
Second.
Second, Christine. Any discussion or comments? All in favor?
Aye.
Aye. All opposed? Nothing? Unanimous. Okay. Next up is to consider and approve the 2026 officer schedule. Guess I'll have to open the floor to chair to start. I think, yeah.
I'll nominate Ken.
Oh, thank you so much. Thank you.
I'll second.
Third, okay. Any other discussion or nominees? Victims?
I'll make a motion to approve.
Okay. Any second there?
Second.
George? Okay. All in favor?
Aye.
Aye.
Aye, I'm sorry, aye. Against? Okay. I'm honored to do it again for 2026. Thank you. I mean that sincerely. I appreciate the confidence. Vice Chair. Tom, you're the Vice Chair, correct?
I am.
Are you willing to continue?
I am.
Okay. Anybody like to make a motion?
I will nominate Tom.
I second that.
Make a motion to vote.
We had a motion from Mr. Leeper. Anybody a second for a vote? Okay. All in favor of Tom Collmore as Vice Chair?
Aye.
Yep. Against? Okay, another unanimous vote. Congratulations, Tom.
Thank you, Ken. Thank you, everybody. Appreciate the vote of confidence.
Yeah, no, it's sincere. I really appreciate it. And you've been excellent help, so thank you. That leaves a secretary?
Yes.
Okay. Who's our current secretary?
Eric Newman is the current.
Okay. Eric, are you interested in continuing on as secretary?
Sure, yep.
Okay. Would anybody like to make a motion on secretary?
I'll make a motion to nominate Eric.
Eric Newman, okay, second from Mr. Leeper. Any discussion on the matter? Okay, anybody want to make a motion to vote?
Make a
Mr.
motion.
Leeper,
Second.
Tom Harris. All in favor, Eric Newman? Aye.
Aye.
Opposed? Okay, congratulations and thank you very much. I mean it.
Thank you.
It says something about our town, to tell you the truth, that we have people who are willing to step up and not just volunteer, but volunteer for, serious jobs that require some actual work. So thank you very much.
I want to recommend that new members not be named Tom or Eric, however.
I think we can make that a rule, actually.
I mean, you four have been so great. Why not add more?
That's right.
Yeah, just got a
That's
prerequisite.
good. Okay, so before I turn it over to BlackRock for a performance review and a continuation of our strategic allocation discussions, I just wanted to let you guys know something and also say thank you to Josh Barbash. I've found that the quarterly visits to the Board of Finance and the annual visit to the RTM, and this is not complaining in any way, can become stressful because I come there to really give a brief performance report, and then for whatever reason, the questions just start coming in like fastballs on topics that often I don't have an answer to be perfectly honest. I don't consider myself a technical expert on a lot of the pension, machinery, so to speak. And at the same time, our Board of Finance deserves, complete disclosure and information, as does the RTM. So I asked Josh if he would be willing to come, what was it, 2 weeks ago now? I'm losing my mind. If he was willing to make the trip, which he did, to come to the Board of Finance meeting with me. And I basically introduced him, said a few words, and turned it over to him. And I thought he did a genuinely excellent job of going far deeper than just a surface performance report. And he he flew in, he was in Chicago on a meeting and then got on another plane and flew here late in the day to do this for us. So I think that's above and beyond, I really do, on a personal level, but also I think it was extremely effective. And I hope, all kidding aside, that will hold things over till the next year I can get them to come back. Because, I don't personally think it's very productive to be getting into, real nitty gritty about actuarial stuff and all that kind of stuff at a Board of Finance meeting, which tends to go late and everybody's tired and whatever. So Josh, I just wanted to say thank you.
Yeah, I want to reinforce, I just want to reinforce what Ken said. I thought it was very informative and very well received. So it was a great job.
Thank you. My pleasure to help. We're here as partners, and when you need our help, I'm very happy to pitch in and enjoy a quick dip into Fairfield always. At least I beat the bad weather.
Yeah, no, that's true. You got in and out. So that was good. Anyway, so thank you again. I'm going to turn it over to Josh to bring us up to date on the performance. Oh, I'm sorry.
The meeting schedule.
Correct. Josh, you'll have to hold on a second. So we need to create a meeting schedule for the coming year. I've just been informed that the charter says we must have 10 meetings, which I think is too many, but that's neither here nor there. So would a simple thing to do, could someone pull up our meeting schedule from this current year? And maybe we just work off of that? Does that make sense? I don't have it listed in that fashion. I have it in my calendar. Does anybody have it like in a list format? Calvin?
Yeah, got it here.
Yeah.
Is it this board named specifically in the charter, or is it all boards that must meet 10 times?
I'm assuming it's the JREB.
Because I remember Carolyn at one point had talked about trying to maybe going to quarterly, but I guess that wasn't it's not a reality.
This is,
It seems like we're actually below our.
or is this like updated in the new town charter? So
must
looks
be.
like in
I talked to Phil about
2024, we only had 8. 2023, they had 6.
Seems like we're below our required amount then, because I spoke with Phil about this in preparation for this meeting, and he said that the town charter says we need 10.
People have been just out of compliance with the current, with the charter.
Yeah.
Okay.
We always did 10 when we were calling the shots. But once we went to the OCIO, we reduced it. Because obviously they're more involved. But it says something in the charter that we have to have a meeting. I guess we have to have a meeting.
What do you guys think? Something like, what do we do right now? We do the 4th, typically we do like the 4th Wednesday.
Month, yeah.
Some one day,
do
some
like-
are off, and then one over the holidays.
I was gonna say, we pick 2 months, we don't have a meeting, and then 10 we do, I guess.
So like a no December, no
No
July,
December.
or July or August.
Right. Does anybody have any feelings on this?
There probably should be no November because Thanksgiving's around.
Yeah, so we do this one early.
And then
So
no
skip
July or no
November.
I like that.
Early
Why don't we
D's.
skip November and either July or August, and then have an early December one like this?
Most people are back for like school because school starts early. So I would vote. My input would be to skip July, and then we skip Nov and we do early in Dece.
Okay, fine with me.
Sounds good.
Fine with me.
And we skip to
So
the
Calvin, you want to pull out the schedule and we're just gonna do the third,
Fourth Wednesday of every month.
Wednesday of each
skip
month.
November and July meeting.
and December would be what date?
Oh, we said December.
we do the first Wednesday
First
like
Wednesday
we're
in December?
doing this. First
Okay.
Wednesday in December.
First Wednesday in December.
Okay, so let me try and phrase this so we can vote on it. We'll meet the fourth Wednesday of each month, excluding July and November. And in December, instead of the fourth Wednesday, we'll do it on the first Wednesday. Everybody got that?
Yes.
Okay. I think that's votable. And Calvin, you'll collate all this and send us out to everybody so we can all put it in our calendars?
Yeah, and I'll send it to the town clerk too, so that'll be up on the.
Right, but send it to everybody on the board in case somebody's not here or didn't catch it all.
Yeah.
And the BlackRock guys. Bob, I'm sorry, BlackRock. is
Hey,
that-
could I interject a question? Calvin, I know it's possible. Would you mind inviting us to sort of a hold the date type calendar appointment so that we don't schedule over it if we hypothetically lose track of which day is which? And
Yeah, I've been trying to send out Outlook invites. I think I do them a couple months in advance now, but I can do them for every single one in the year if you'd like.
I would-
That's a great idea.
Good idea.
I would appreciate it.
Absolutely.
Yeah, that's excellent. If you can do that, that'd be great. Okay. Would somebody like to?
I was gonna say, you were
Give me a
asking
second.
Black.
Oh, I'm sorry. Josh and Ray, is there any problem with what you just heard?
I mean, these are obviously for the JRIB to stay present and current on the portfolio. So,
Well, I just meant the dates.
oh,
Yeah.
yeah, I could have sworn the fourth Wednesday is also part of the charter, at least when we were onboarding with Carolyn. I remember that being something that came up. But certainly,
That's specific.
Yeah, jeez.
Okay, so it sounds like we can vote on this.
I'll make a motion. to
Yeah,
vote.
thank you.
Second?
Second. Any discussion or comments or anything? Okay, anybody like to make a motion to vote on that schedule as just described?
So moved.
Tom?
Seconded.
Second.
Thank you. All in favor of that schedule?
Aye.
Aye.
Anybody opposed? Okay, carried unanimously. Thank you. Does that take care of all the administrative work, Calvin?
Yes.
Could I interject another request? We've talked over the past few meetings about the timeliness of materials submitted. I'd like to, I'm not sure this is a motionable request, but I'd like to put it out there with everybody on the call that we expect to get things. I think the town charter requires things a week in advance. I think in the last meeting, it became, speaking for myself, it became apparent that it's a sensitive issue. So could we, I don't know what the right protocol for discussing this or voting on this or just all agreeing informally that this is the case. But if we could all stand our ground that we need to get our materials 1 week ahead of the meetings, relevant meetings, I would feel strongly about that.
Well, speaking for myself, I agree with you 100% in spirit. I'm a little concerned about codifying it only because there are probably times when a document just arrives 4 days before the meeting and there's just no way it could have gotten a week. And I wouldn't want to, for example, cancel a meeting for that reason.
Sure.
So would you be comfortable, Tom, with a sense of the body, so to speak? That's what our goal is?
I was when I listed the possibilities, I was open to anything. So if informal works for everybody, that I just want to be. I think we just need to be clear. And if there are exceptions to be made, that's fine. But I like to be clear that the expectation is 1 week in advance.
Okay, I don't think there's anything to vote on, but I agree 100%. And I'll just say that I've been involved on these boards one way or another for 15 plus years in the town, maybe more. And I've never worked with with someone like Calvin in terms of the quality of the work we're getting. And if we are asking him to do that, my guess is he'll make it work.
Great. Yeah, totally agreed. Calvin, thank you for all the hard work. And I share Ken's confidence that you can make this happen.
Appreciate that. Thank you, Tom.
Excellent. Okey doke. Josh and Ray, you're up.
great. Well, thank you again, Ken. We'll talk a little bit about October performance to kick off and then jump back into the SAA discussion. We do not have official November performance updated yet, but I can give you some color of where the portfolio stood as of November 30th from an asset allocation position. Within the deck that we sent around, I think page 4 gives a nice color on kind of asset classes as a whole, but probably more important for everyone to look at page 5, which is the performance for October, also listed the fiscal year-to-date performance. We at the October meeting, we talked a little bit about performance through September 30th. October was a lot of a continuation of what we saw in August and September, just the continued AI rally with the U.S. equities really leading the way. The second rate cut from the Fed in October, helping to buoy markets a little bit, easing financial conditions, generally positive for equity markets. But as we progressed through October, we had, the months-long continued government shutdown, lack of financial data, macro data that markets tend to crave. We saw November be a lot choppier. Seasonally, November sometimes is pretty choppy. but this was a lot because of uncertainty around macro data. We saw a really big whipsaw in kind of the prediction markets on the Fed cut. We came into November at near 90% likelihood that the Fed would cut. By late November, that was 40%. And as of the beginning of this week, it's back up to 70 or 80% likelihood the Fed is going to cut. A lot of that is just on, private companies providing this data, ADP collecting, jobs gains or jobs losses data that surprised a bit to the upside, but revised August and September numbers looked a lot worse. So kind of a continuing softening of the macro, of the financial markets, of the labor markets, excuse me. And then we had a little bit of kind of AI fatigue, if you will. Valuations had gotten pretty stretched. We saw a bit of a market correction in November, especially around the tech and the big names selling off pretty substantially intra-month. Net, we think that November, you all ended up slightly positive. But looking at October 1st, the pension portfolio was up just under 1.4% for the month of October for a fiscal year-to-date performance of 6.6% through October month end. Again, a lot of that driven by the equity portfolio, the equities rallying again in October. You'll notice on the top yellow line that the assets in the pension fund was $529.7 million at October 31st. At November 30th, that stood at $528.1 million. Slight decrease in the asset value, but it's driven because we raise $2.75 million monthly to pay benefit payments. So the actual return on the pension fund that we're estimating for November is around 0.25% positive, bringing the fiscal year-to-date performance through November 30th at 6.85. Nearing that 6.9 target return for the year, equities again continue to drive the strength in the portfolio here, and we'll see a bit more on the fiscal side from the OPEB funds being a bit higher allocated to equities, stronger performance there. So the total OPEB funds stood at $110.6 million at the end of October, with a 1.6% return for the month of October fiscal year through October 31st of just under 8%. As of November 30th, the OPEB assets stood at $110.9 million, another estimated about 0.25% return for the month of November. So even though equities were pretty choppy, we did see still positive fixed income returns as yields came down a little bit towards the end with the higher pricing in of Fed rate cuts. We suspect that there will still be some noise in markets going forward, but we expect the Fed to cut rates at their next meeting in a little under 2 weeks from now. That will be 3 rate cuts for the year. We're still expecting terminal rates to hover closer to 3%, which would be another 3 or 4 rate cuts in 2026. Certainly, there's some noise around some new Fed governors with 2 open positions in 2026 for President Trump to nominate for. We expect there to be governors who will want to look at cutting rates a bit. So we expect that terminal rates coming down, that'll be positive for equity markets going forward, sustaining softer or looser financial conditions. And certainly Q3 earnings that we just experienced were extremely strong. So we suspect that there is some balance to the equity rally that we've seen as we see it in earnings growth. The S&P earnings growth for Q3 was plus 14% year over year, obviously led by AI stocks, but non-AI stocks up 9% year over year, very strong and broadening out. And as we see, the Fed cutting rates, easing financial conditions, that's generally been positive for small cap stocks that have lagged large cap, especially tech-dominated large cap. We saw EM earnings growth, similar story, the tech-driven earnings there up, 20 to 30% year over year, but overall EM stocks saw 12% year over year earnings growth. So it's broadened out. It's not just a NVIDIA story. It is, very broad. The one area where there's softness in earnings is Europe. But there's positive fiscal impulses continuing to come from defense spending. We see, again, similar valuation stories with stretched U.S. valuations and European stocks still looking very attractive from a valuation perspective. So we do think that there's still room to run and reasons to be positive for a 2026 performance. But where we stand, obviously, through November 30th in both funds is very strong and at or above the kind of a total expected return for the year. And so, continued further run in equity markets will lead to, continued outperformance relative to that target return.
Can I ask you one quick question, Josh? I'm just interested for myself and for us. In my entire investing career, I've never seen a bigger gap between markets and the economy. Ever, actually. The economy strikes me as not particularly strong. Unemployment seems to be, employment growth, it seems to be slowing down. And all I read about is all-time record auto repossessions and people way behind on their loans and stretching out the length of the loans and et cetera, et cetera, et cetera. And at the same time, you have a corporate world, largely dominated by the tech world, I guess, that are going gangbusters. Is that a sustain? I guess the question is, historically, or in your guys' opinion, is that a sustainable situation where the people are not experiencing? At least I don't think they are.
Yeah.
The stock market.
I mean, I think, look, there's a lot of talk right now about kind of the K-shaped economy, where higher income levels are still participating and doing well and helping kind of maintain the economy and the consumer spending where we see it. Certainly, there's been instances where this kind of K-shaped economy has existed in the past. You can think of, not to say preceding the global financial crisis, but that was one area where things got much more out of tune. That was a little bit housing driven. But we've seen instances just even in the last 10 or 15 years where there's been this little bit of bifurcation. We saw a little bit of it in 2021-ish, 2022, kind of coming out of COVID. We're certainly a bit tighter from a fiscal perspective, right? Everyone's talking about the budget deficits and trying to tackle waste and spending in the government, but that hasn't slowed the fiscal spending. That hasn't slowed fiscal spending in the past. I don't think that we're on a precipice of there's no more fiscal impulse that you can give, and I think that there might be some appetite for fiscal support if the economy starts to turn a little bit. But I think the bigger headline news is that the economy GDP growth annualized is still strong. There was a bit of a dip over the summer, but we saw a pickup, and the estimated kind of GDP now factor of just under 4 annualized for the quarter is going to be continued strong. That's going to pick us up a little bit above 2 for the year, which has been a target. I know that the administration is trying to target higher GDP growth than that. But I think some of the AI build out remains to be seen of how much supportive that's going to be from a productivity perspective and supportive of earnings growth. I think that's a big key number to watch, is even though valuations might be a bit stretched, the fact that the earnings growth numbers are much stronger now than, say, they were back in the tech bubble means that, at least from a stock market perspective, that's pretty sustainable.
I would just add that the AI productivity is certainly coming through the corporate side in terms of the savings that they're seeing. And I can give you like a live example just from BlackRock, where I have to do reviews on our team, and you have to go gather all the feedback from what people said about the people on the team. That used to take me an hour or two. I did it in 30 seconds today because they have an app that goes and captures all that feedback and gives you a rough draft so you can start to work off of. Now you take industrial companies, healthcare companies, beyond the Mag 7, they're all starting to benefit, and it's starting to come through. And I think the market continues to price that in. I know, Josh, if you disagree, let me know. But
that's a good point. I appreciate that. I mean, not that it matters for our purposes, but all I keep reading about is that sometime in the not that distant future, we're going to have to figure out how 20 or 30% of the people are going to occupy their time, right? Because they don't necessarily need to work, and we can still have the same or higher GDP with a lot less workers. I don't think it's really tonight's business, but it is interesting. Any other questions for the BlackRock guys on a performance report basis? It's always nice to get good reports, right? Markets have been very strong, and our performance is admirable for now.
Certainly. We could pivot to the asset allocation discussion. So I know attached to the materials in the kind of back section is all of the materials from the October meeting. So if we need to reference the options, the allocations, that's all in there. What we
Yeah, it
added.
starts on page 27, I think.
Yeah. So we added, we did add for here, there was a request for the stress test to incorporate option D, which is the portfolio that includes additional private market allocations, namely adding private credit and private infrastructure, bringing the overall private market allocation for the pension fund up to 20%, and for the OPEB fund up to 30%. Let me just make sure I got that one right. Yes, 30%. Obviously, the diversification, and I think the real takeaway from all of these is you're adding asset classes, especially the private infrastructure asset class. It's a bit diversifying. So relative to option C, which is all private equity, the diversification, it tends to do about the same. The tech burst being one where anything with real assets was performed a lot better. So that would be your options B and D under the tech burst. This is kind of equities really do poorly, and unless you own very long bonds, the other thing that did well was real estate, and infrastructure would have done well here too. For the most part, the other two stress tests that we have, the option D is about in line with your options B or C, which are the options that have the current or all private equity in terms of private markets. Again, the diversification benefit of the diversifying fixed income assets, the high yield bonds, the emerging market debt, the bank loans, tends to perform better than the current portfolio in some of these stress tests. And so you do see a bit of a benefit in option B and C relative to the current portfolio in some of these stress tests. It's not in every market. Certainly there's characteristics of each of these stress tests where the impact is where the portfolios end up about the same. I think the other important takeaway from the stress test scenario is remembering to recognize that we're focused, on our risk, kind of three big risks. The first risk is just kind of relative to markets. How did the portfolio do? So if S&P is down 30, are these portfolios down 25 or 20? Kind of is the diversification helping avoid just that huge drawdown from the market? The second aspect is you smooth actuarially a lot of the gains and losses. So a one-time big sell-off, how impactful is that overall to your funded ratio and to ultimately a contribution number? What is the impact financially to the town in a next year perspective? And with all of the smoothing, that bottom row number outside of, option A, which has much worse drawdowns, given it's all liquid and doesn't have as much diversifying assets, the contribution impact is not that different across portfolios on a one-year basis. And so then finally, the last thing to remember is when we looked at the table of all of the allocations, that long-term expected return is an important metric to be cognizant of, because earning under your expected return for 5 or 10 years has the knock-on effect that maybe this year or next year's contribution isn't that much worse, but it's the contribution 5 or 10 years down the road that's a lot worse than it would have been if you were able to maintain the return that you're actuarially based on. So the advantages of options B and C and D are that their expected returns tend to be a bit higher than the current portfolio. And so avoiding that longer term potential underperformance is one of the goals and reasons for looking at some of that diversification, not just short-term drawdown, but achieving that long-term return over a longer period of time. So I'll pause there on the stress tests. We also added, I thought, an interesting peer comparison that I'd love to have a little bit of a discussion on as well.
Sure.
So we did, one of the things that we tried to add in here for a little bit of color, right, is to work with a peer comparison of area pension funds. So hopefully these are towns or cities that we can think of comparatively to the town of Fairfield, and looking at the portfolio allocations. And page 17 is a couple of the main takeaways that we have, is that I think importantly, there is no one size fits all. There is no, this is the allocation that guarantees your return or that hits your expected return. I think somebody, I don't remember who on the October call, brought up, these are based on our capital market assumptions, and any of these other towns might be using somebody else's capital market assumptions that have very high equity allocations. I'm just looking at, on page 16, Westport right next to you has a bit higher public equity allocation and has a return that's almost 80 basis points, expected return that's almost 80 basis points lower as their discount rate. So there is no one size fits all. But I think generally what we do see is that equities and core fixed income, the building blocks of the Fairfield portfolio currently, are generally the building blocks that we see across portfolios. There's generally a slight home country bias, a tilt towards U.S. equities versus non-U.S. equities. And we certainly see that a bit more in the fixed income side, a bit more heavy use of just broad U.S. fixed income than that allocation to non-U.S. fixed income. BlackRock's strategic views right now are that non-U.S. fixed income is an attractive area just from where rates are, where we expect long-term U.S. rates to move versus broadly non-U.S. rates are expected to move. And so, you can also see that most of these towns are using broadly U.S. fixed income. And then it's a big mix of who's using private markets and who's not. Some towns are using hedge funds as their main source of alternative allocation. Others are using real estate. Others are using private equity. Say the lowest pickup is probably private credit, not really used across towns. We see, maybe sophisticated investors. Greenwich has allocation to private credit. But for the most part, again, it's no one size fits all. So this is not to say, change is adamant because everyone else is doing what you're doing or not doing what you're doing. But I do think that your portfolio fits in generally pretty nicely as a pretty well diversified portfolio relative to what some of your neighboring towns are doing as well.
Let me, thank you. Let me throw a question out to the board that I think is important, because I think that, these options, which are all good options and all well thought through and with very logical, very logical rationales behind them in terms of diversification, risk tolerance, and expected returns, and so forth and so on. Let's leave aside the liquids for a second, and I just want to get a sense of the board about the feelings on alternatives generally, right? We've talked about that a lot. We've had a lot of experiences here in Fairfield with alternatives that have been, frankly, not good. Although, I don't know, it's funny, I don't really consider Madoff or even Allianz to be alternatives, to tell you the truth. They're not part of the normal, what people think. I think we can agree that people generally think of stocks and bonds and cash as being normal, right? Or being part of the base portfolio that anybody's going to have, right? It's unlikely we're not going to have those three things in one way or another. Obviously, not too much cash. And then, of course, you'd have international, domestic, et cetera, et cetera. But I've heard from this board a lot of different comments and feelings about alternatives, right? That's number one. And then once we discuss that, then we have to decide which alternatives we like or don't like, right? I mean, obviously, I'll just name, hedge funds, private credit, private equity, real estate sound to me like the four big ones. In one way or another. So I'll just throw it open a little bit to anybody. There's no right or wrong answers here. The answers can be financial or emotional. I'll just say one thing. I don't think Josh or our experience has shown, and I'm even leaving aside the disasters, I don't think anything has shown that the alternatives have been gangbuster benefits, right? We've done okay in some of the choices we've made, but it's not like anything has been such a clear and decisive benefit for us that it would be crazy if somebody said, well, I'm just not comfortable with alternatives, right? It certainly would be a reasonable thing for someone to say. On the other hand, I think there's enough evidence out there that alternative investments bring something to the table, right? And they probably have a place in the portfolio, whether it's 5%, 10, 12, 7, I don't know. So I'll throw it open and see if anybody would like to speak about it at this level, at a high level, conceptually.
Yeah, I'll say from my professional experience, I am very open to alternatives. I believe they have a place in the portfolio, but from dealing with sophisticated hedge funds, endowments, foundations, I think a lot of it comes down to the team that's picking the managers and the education that they have, and it really is like a people, process, and investment strategy. Like you got to pick, you have to pick the right manager, and if you can have a team that can actually do that in a thoughtful way and construct your alternatives portfolio.
You're talking about the monitoring level.
Yeah, I'm talking about the monitoring level.
Right.
So for us to sit here and think that we would individually pick these managers.
Well, I hope nobody thinks that.
Yeah,
Right.
I don't think that we would have much of a value there, but if we have our OCIO being able to monitor and have their whole team of BlackRock analysts go ahead and pick them, then I have a lot more faith in them to successfully do that. Then
I think I can speak for the board that everybody agrees with that. I don't think anybody here thinks we should individually be picking and choosing managers.
No, but it's just I've seen some endowments, foundations that go ahead and they have some alternatives that don't work out that well. But then they tend to be, when you put them side by side with some of the ones that do work very well, kind of the competence level and the sophistication of the teams picking those alternative managers can be very different. And so I think that as long as we have faith in our OCIO to go ahead and actually monitor and select those for us, and we think that they're top notch in that area, then kind of I have faith to add them in.
So that's a vote for the concept of having alternatives in our portfolio.
And I would agree with that. I mean, as a policy, I think that's a vehicle that should be considered. Again, I don't think it's our job to select the individual investment. I mean, that's what we have these guys.
Correct.
But as a policy, I think it's an opportunity. I don't know what the allocation should be, but I think as a policy, something that should be considered for inclusion in the portfolio.
Anyone else?
Yeah, I'll weigh in that I think we need to introduce the concept of high conviction recommendations here. I totally agree with Nick and Tom. I think if Josh, you're obviously on the call. If Josh comes to us and says, this is a high conviction manager selection, that would be a compelling argument. If on the other hand, it's simply an asset class recommendation without that high conviction, and I'm not trying to say I know what that sounds like when Josh gives us that message that it's a high conviction recommendation, but speaking for myself, that's what I want to hear. This is a high conviction. I have a high conviction that this particular manager is a good manager, and that you'll have a good experience relative to whatever metrics you want to evaluate them on. If on the other hand, it's purely an asset class recommendation without that kind of high conviction, I'd say let's just stick to public markets, public equity markets in particular, overwhelmingly, and take it that way. Because I don't think as a board we have that expertise, and I'd want to hear from Josh and Ray that expertise does exist, and if it doesn't, I'd say let's take a pass.
I think that's a good point. I would, and George, I think you wanted to speak. I was just going to add in that the one thing I would like to see, which I think you've already done to some extent, but maybe just make me a little more comfortable, would be I have a slightly different take, not necessarily on whether or not they're good, bad, or belong or don't belong. I, maybe a little cynically, but I am pretty confident that we will be average. And I don't think that anybody's going to bring us any special managers or convictions, or, I mean, they might think they do, but I think at the end of the day, we'll have some winners and some losers, and we'll end up being average. So one of the reasons why I think we're all comfortable with public markets is that average, and we are indexed, has proven to be a very lucrative environment for all investors for many, 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 many years, right? So I'm also in the camp, by the way, that there might be a place for these products. But I would caution everyone here to think that if we are going to figure out a way to be, top 10% or whatever, and I think in some cases we have been told by our advisors that you need to be in those upper echelons to make it worthwhile. That would be my difference. In other words, I always say this because I remind everybody here, you got to be very careful about confirmation bias, meaning right now, as we speak, there are pension board meetings all over the country, and all of them have very intelligent, capable people advising them, and they're all going to be bringing recommendations that they say are wonderful, and we've done our research, and so forth and so on. But by definition, they can't all be top 10% or top 20%. They're going to be average. So
I think that
yeah. So if the product is average, so if the average result of the product is good, then it belongs.
I think that like the easier thing to do, and sometimes a lot more value in it, is rather than having picking the top 10% and getting access to those funds is very important. But on the other flip side of that is avoiding the bottom 10 to 20% is extremely valuable.
Of course, but we've gone back and forth on this. If that was easy to do or even possible to do, nobody would do it.
I think it comes
right. Why would anybody choose the bottom 10 or 20%?
Like people in process and actual evaluation of the.
No, I understand. But I don't want to beat a dead horse, but I'm just saying there's nobody meeting at every single pension board meeting going on in the United States today. Nobody's saying, please give us the bottom 10% or bottom 20% of the funds. So by definition, somebody will get those bottom 10 or 20%.
Somebody will, and I think that there is actually manager skill that comes into play. They say.
Well, okay. We have to fight about it.
It might be worth just refreshing on the resources that are dedicated at BlackRock to selecting managers on the private equity side. For example, you had heard the PE team come in. Josh, maybe you want to touch on that a little bit.
Yeah, because I think you hit the conversation has hit two big points on kind of alternatives. First is kind of asset class. I think Tom was talking about, just asset class or, kind of CMA. There is kind of inherently broader opportunity set in private markets, just companies staying longer. And, I don't want to rehash all of the points our private equity team brought up when they were in a couple months ago. But, one of the points is kind of opportunity set. And from a forward-looking expected return, there's more positive kind of conviction in forward-looking return from private equity or private market assets than just public markets. So part of the reason for inclusion is, the CMA is not thinking this is the 10th percentile manager. This is broadly average across the private market universe. So thinking median, that the asset class itself is additive.
That's helpful. Yeah,
I do agree. And Nick made the point on picking managers is important in this asset class. There is a much wider breadth of outcomes in an asset class like private equity than there might be in public market equity, where the top quartile and the bottom quartile manager might not have hugely different outcomes. That is a case in the private equity side, where being median and above is substantially better than being median and below. And it's really important part of the people in the process around that manager selection piece. And to Ray's point, we have a dedicated private equity team that manages, a couple $100 billion in private equity assets that is focused solely on sourcing private equity managers. That's their day-to-day job, not even my day-to-day job to say, I like this manager better than others. Like, we're relying on the advice of our expert teams that are in this market on a daily basis. On top of that, it's that process around kind of monitoring those managers. It's not just making sure that you pick the managers, being able to monitor. And, combined with our private equity team, BlackRock's manager research team has dedicated feelers out to a number of the private equity managers themselves and kind of documenting what their process is, documenting deviations from process, who would we want to continue to include in portfolios or not.
Hey, Josh?
Yeah.
I'm sorry to interrupt, because you bring up an interesting point. I mean, I don't agree with it, but could you guys, in other words, that all sounds good. Could you actually bring us some data that shows that you guys have actually identified managers that you, for some reason, you think are going to get bad, and that you've pulled assets from them and then actually they've gone bad? Because my guess is that it'll be exactly the opposite. You'll have some that you thought were going to go bad and they went good, and some you thought are good are going to go bad, and so forth and so on. And I'm not being critical, by the way. I actually think we're very lucky to have BlackRock. I think you guys are the best in the biz. I just don't think that Victor Wembanyama is actually the best center in the NBA right now, in my opinion, right? He's 7'6". He does things that other people cannot do. I don't think that's an analogous to this. In other words, I think all of your competitors have these teams that you're describing, maybe not quite as big, and they're all doing the same analysis and the same work and the same good faith. So again, I want to make clear to everybody here, I am not banging the table anti the product. I would just like to know that we are going to be happy with the product if we're average, because we will be average over the whole thing, meaning we'll have some good funds and some bad funds, but I guarantee you, if we have 4, 5, 6, 7, 8 funds, we'll be average. And if that's okay, meaning that's a good performance, then I'm all in.
But comparing that to the other allocations that we could have, we would be down,
Well, maybe not. No, my point is if private equity is
dragging us down.
If private equity is a attractive product where the average remember something, we're average in equities, right? We're an ETF equity manager. So we're getting whatever you see every night on the McNeil Narrow Lose Hour when they tell you that the market was up or down. That's what we're getting, right? So and we're satisfied with that because it's been great. If we believe that private equity as a concept is going to be a better way to get equity, right? Because on average, it will perform hypothetically 0.5 percentage point better, or whatever the number is, with better volatility, whatever, then I think it's a very good idea for us to consider it. But if we're depending on picking better managers from the universe, I would not be willing to support it. That's all I'm saying.
Right. I mean, if we're looking for it to hit a home run in a 10% allocation, to sway.
We don't need a home run. We just don't.
This is just assuming that,
But they're selling
private equity is, in their capital market assumptions, right? We have U.S. large cap is going to hit, call it 7% return on a 18% vol. They put private equity hitting a 13% return, but you're on a 28 vol.
Mm-hmm.
So I mean, you're
more winners and losers. That's all.
Yeah, I mean, but you're expected.
Right.
So if
you're
they're right, like what they're.
And that's an answer to my question. Hang on a second,
13%.
George.
Right. I agree with what has been said so far. Beyond the concern that we have to pick average or above, right? Because we would have to somehow, using the team, pick average or above. I have a bit of uncomfortable feeling generally about some of the alternatives, simply because of lack of transparency, right? And we've all seen that, whether it's everything's a quarter later, or we pay fees based upon committed as opposed to what is already in the funds. I think we have to weigh those and the fact that they self-measure themselves effectively. And they really do. They measure how well.
Sell access to themselves in little subsidiaries and so forth.
Correct. And so we have to weigh that, and that has to be a part of it. So I think it's, when we look at the whole, and I'm not against private equity completely, right? I think there's a place for it. But I think we have to know how it's picked, and we're comfortable with how it's picked, comfortable with what we think that average expectation is. And is that a better return for that 10% of our portfolio than U.S. domestic equities?
And what you're saying, George, if I may interrupt, is that which is all correct, by the way, is that with everything you said, it still could be a good product for us. In other words, the expected return, we could get comfortable at this table with the expected return of the average private equity fund or real estate or whatever. And that's because we're incorporating all the things you're describing, the illiquidity, the opaqueness, the lack, the month-long wait for return information. All that stuff is fine if we feel comfortable as a group that the product is beneficial.
Right. And with their expertise and seeing the track record of private equity or whatever the alternative is, right? And they've seen many, many, many of these. What are the telltale signs in those investments that say something's going bad?
Well, there's no such thing.
Right.
There's no such thing. If that was the case, people would do it. Right. So that part of it, I think we should disabuse ourselves of. We're never going to, there was like one person in the world, Harry something or another, who saw what Madoff was doing, right? Everybody else, the most brilliant people on earth, were invested in this thing. And now in hindsight, it looks so ridiculous that it's comical, right? So the guy was making it all up and writing it in ledgers on the 18th floor and whatever. So I'm sorry, go ahead.
I have a question for Josh. Can you just, maybe at a high level or go as deep as you want, really, step back. We have our capital market assumptions. What is your actual process for selecting the asset allocation? Like, you're not just doing a straight mean variance optimization to pick your weights. Can you start with, okay, we have all these capital market assumptions. How did you create these 5 portfolios? Like, I guess we have our current and then we do A through D. But like, are you doing like a little bit of like a Black Litterman approach where you're like, we're roughly going to stay in these bands of these areas and then we optimize around it? Or like, can you just?
Yeah. So we're going to wonk out a little bit here.
That's fun because
we have
play some Grateful Dead music while you do.
Yeah. So our process for optimization, we call it robust optimization. It's not a mean variance optimization per se, right? Our capital market assumptions are just an input into trying to target a specific return, but we do this from a risk lens. So the metric that we're really trying to solve for is for the given level of return that we want to hit, we're solving for volatility and trying to minimize the downside dispersion around that volatility. And so our optimization process, mixes and matches the assets based on our capital market assumptions, the correlations, the expected returns, all of those components done kind of in a net of fee basis here to produce based on, constraints that we might put in. So if we wanted to cap alternatives, for example, which is what we did in most of these portfolios at the max of what you have now. So we weren't going to reallocate more towards private markets. And how does it rebalance around the rest of the fixed income assets and the equity assets? Typically, what we'll try and do is we'll kind of let our capital market assumptions tilt away from market cap, for example. So we might start with an equity market cap weight. And then through this process, we keep some guardrails around. And for this specific instance, we tried to keep keep pretty close to market cap weight, just given the passive nature of the overall, investment thesis and strategy, keep equities around market cap. And then how are you going to reallocate amongst whatever assets we allowed for the optimizer to choose? So for option A, B, C, right, we allowed it to choose diversifying fixed income assets like high yield emerging market debt and bank loans. And how did it fill out from the assets that you own into those assets, keeping a cap at 15% on private markets, 10% on private equity, for example. We could expand the universe of assets, we could shrink the universe of assets, but it's not necessarily a mean variance approach here. It's kind of focused on, I still am trying to hit this 6.9% return. How do I do that for a given level of volatility and minimizing that downside dispersion risk of outcomes?
And then when you, go to like the mean variance optimization, right? Like if you're going to introduce a new asset class, whatever, like the textbook rule is, okay, if like the Sharpe ratio of like that new thing is greater than whatever the correlation times like the Sharpe ratio of the existing one, you could like then introduce it, add it to the portfolio. Is there kind of like the same, like a similar rule of thumb or like theory here to like when you introduce a new asset class? I kind of ask this because sometimes with like we look at all these portfolios and the numbers are all like very close, and then it's like, okay, like how do I decide like, yeah, okay, I'm gonna go with this one. Do I base it off of just like, oh, this thing in the simulation is 20 bips better, and like
Yeah.
So,
Yeah.
No, I one question there, and then second question would be follow on, like how do you like recommend looking at these different asset allocations when they are so similar? Like what's like the tipping point that's going to make me want to add private credit? Like, okay, I look at D versus B. It's like, oh, I had 5% alts.
Right.
I'm like, we had 2% private credit or 2% real estate, 3% private credit, 3% infrastructure. What's going to make me like really want to do that versus just like avoid them because maybe the board's not super confident in what those are going to be?
Yeah. In terms of, let's see, thinking about additional asset classes here, one, we think about some of these assets in terms of bucketing, right? So you have your public market assets, your public market equities, for example, your core fixed income assets, kind of as cornerstone building blocks of portfolios. You're never going to have a portfolio with 0% to U.S. fixed income unless we were like grossly underweight and had such a negative view of U.S. fixed income, for example, right? But we then think about kind of the return-seeking fixed income assets as a bit of a bucket, right? These are not all investment grade. There's not just U.S. or developed market, core bonds that you have in here, different spread exposures. So thinking about adding them kind of collectively rather than, hey, we should only think about U.S. high yield. We'd want to think about them all kind of together. And then you could think of the alternatives as, we see them as kind of twofold. One is return enhancement and one is income enhancement. Kind of growth and income type oriented alts would be how you would want to think. We may overlay client constraints. So for example, most of the portfolios we ran here only considered private equity and U.S. real estate. Those are the assets that you currently own.
Yep.
We tried to keep fixed the 10 and the 5.
Okay.
So we were a little heavy-handed on some of the constraints here, especially around the private markets.
Okay.
But in terms of picking between the portfolios, I think this comes back to the comments that I was making back in October, is that your current portfolio is a good portfolio. It's pretty well diversified. It has the mix of public markets. You're using private, a 10% allocation to private equity as a bit of a return enhancer with the real estate as a diversifier from the overall portfolio. And you can see that play out, that from a volatility perspective, these other portfolios end up about the same place. You can generate slightly higher returns from some of these portfolios, which was one of the kind of risk objectives that when we had the risk workshop meeting in August, that the committee, the board really focused on was, how do we make sure that we're not earning 6.5, but we're earning 6.9 or 7.1? And part of that is building in a slight buffer. So that's what options B and C are meant to do, is provide a bit of that buffer with some of that same downside risk and downside dispersion.
Josh,
in terms of picking,
Okay.
I was just going to add, in terms of picking a portfolio, right, we looked at the other types of objectives that you had. So one is, how likely are you to earn 6.9%? Well, all these portfolios are kind of about the same because the returns are all about the same. Yeah. But the other element is, what is the financial cost of these portfolios? You have to pay out your benefits. You're kind of amortizing this shortfall that you have over time, and that results in contributions. And so we added not just stress tests, so what is a one-off loss look like for many of these portfolios, but over a 10 or 20-year period, do either of these portfolios provide some financial benefit in terms of better funded status, lower contributions? It depends on the entity for a corporate pension, they might worry about balance sheet impact beyond just kind of contribution elements. That's not necessarily the case here. And so, if you included in the deck, page 29 was a summary of outcomes. And I think one of the things that we arrived at in October was, again, the dispersion of outcomes is not all that great difference between the portfolios, other than option A was really kind of negative from a financial perspective relative to the current options B and C. When you looked at contributions, when you looked at the total value of the portfolio, the funded ratio. But for the most part, the dispersion is not all of that great. And so I think your point might be, what would incentivize us to shift off of the current? And I think the answer would be, do we want to have a bit more diversification from a fixed income perspective? It allowed a slight decrease in the equity exposure of the portfolio. So from kind of a significant drawdown perspective, if you compare option B or option C, we can look at option B to the current on the stress test slides. Option B is slightly better outcome. Again, this is not significantly better outcome. You're not going from a 60% equity portfolio to a 30% equity portfolio and avoiding all of that equity drawdown. You still need that return. That 6.9 bogey is a bogey. And based on the dispersion of our capital market assumptions, does require kind of pretty similar sized levels to equities, unless you really want to go like Yale model and go like 60% alts and then kind of go all in like private equity and infrastructure.
We'll buy timber. Let me ask you two quick questions, or one question, one comment. When you're working up these expected returns and other characteristics of the different alternative products, right? These 4 products. I should have asked this question before. What are you guys using as your expected results? I mean, are you using your expected average returns for those products, or are you using some special returns because you guys think you're so good at it?
The capital market assumptions. The capital market assumptions are generally kind of average. I'm guessing, Ken, your point is on the alternative side, the private market.
Yeah, no, my point is that when you expect equities to return 6.9% over the next 10 years, that's 6.9% on the S&P 500 that we see on TV every night, right? So when you're looking at these 4, I'm just trying to understand this. When you're looking at these 4 products and you're giving us your expectations for how they will perform on a return and volatility and whatever basis, are you looking at them as how the average fund in those categories will perform?
So, yeah, they're not, the private market side is not necessarily based on funds. It's based on kind of the available data on all of the deals within that.
Okay, however you want to phrase it.
So it takes in a very broad universe of each of these underlying asset classes. Kind of thinking back about historical outcomes, but then looking at present day metrics and building off a projection model off of that.
Okay, and I apologize, it's not my area of expertise. Are the numbers that you guys are putting in here for your expectations the same as every other advisor is giving their clients?
Probably not. I mean, all of our capital markets, you can even go back to our public equity capital market assumptions, are not going to be the same.
I don't mean to the number. I'm saying generically. In other words, if I polled 10 of your competitors, are they going to say that private equity as a group over the next 10 years will return whatever number Nick said, give or take a quarter of a percentage point? Or am I going to get numbers all over the map?
I'd say directionally, we're probably very similar. So I think across the industry, private markets, especially private equity, has a premium on global equity returns. So there's some type of private equity premium, a liquidity premium, just asset class premium above global equities. Mm-hmm. I don't know the range that,
I'm sorry. What I'm trying to, I know I'm beating a horse here, but I think it's somewhat important. What I'm trying to get at is, again, I want to emphasize this. I am not, because I know I'm speaking a lot, I'm not anti all these products. I even own some myself. I am concerned that we're kidding ourselves if we think we're going to get special returns versus the marketplace. So if we can be comfortable that these are good products that make sense for us because they are good products, right? If I order it from Amazon, a box of chewing gum, I'm sure one of them might taste better than the other, but in general, I'm going to get an average box of Double Bubble, right? So if you could tell me that our boxes of double bubble are going to add value to our portfolio, I'd be very interested in hearing that from you. But if you tell me that, Ken, you better hope we're good at what we do, we better come through, we better pick you these top 10% characters, then I'm going to be a very strong no. That's comment one. But you guys have heard me say that 10 times. A second comment, which I think is somewhat interesting, at least I do, is Nick asked a good question, I think, which was why would we pick one of these portfolios versus another since they kind of all have generic, somewhat similar outcomes, projected outcomes. And I don't think it's unreasonable. I'm just thinking about this. I'm thinking about George's comment a second ago. So George gave us some non-financial, emotional reasons why he doesn't exactly love some of these products, right? He said he doesn't like the fact that we get our reports from them months and months in arrears, that we don't really have any idea what these guys are doing, right? It's a total black box. They do all sorts of stuff that maybe we wouldn't be so comfortable with, et cetera, et cetera. I'm thinking about this now a little differently. I don't think it would be unreasonable, given that there aren't radical different return scenarios being presented to us, that would be a reason for us not to be comfortable with a product. Okay? In other words, if we really thought that this was going to bring glorious bounty to us, then we'd have to kind of overlook some of that. But if it's a very, very marginal type of thing, and a lot of people on the board have a lot of reasons, and forget that, we just spend a lot of time talking about this, right? Every month is the exact same story, right? We're always moaning and complaining about the way these numbers are presented to us and how they're always months behind, and we never really know what our real performance is because we never have all the performance at the same time, et cetera, et cetera. Some people don't like the fact that we're paying fees on capital that's been committed rather than called, which I agree with, but I guess that's just the way the industry works, and so forth. So do you guys understand what I'm trying to say? I don't think that's an unreasonable reason to not like something if it's already only a marginal contributor to our performance. If we all thought that we have to suck it up because this is a great contributor to our performance, then I think we'd have to, think of it differently. I don't know if that makes some sense, but it sort of dawned on me when I heard George raise some non-financial concerns. I mean, they're sort of financial, but you know what I'm saying. Anyway, Tom, are you waving to speak, or what are you doing there?
He's scrolling.
Oh, okay, I'm sorry. Anyway, Calvin, you're welcome to speak up. You're a member of the team.
When looking at this, I see Darien and I see New Canaan, and that is what I would prefer. I would prefer a simple 3-fund portfolio or even 2-fund where we do 20 to 30% in bonds and 60 to 70% in U.S. and international equity. I don't think that a lot of these.
Yeah, they have a benefit that we don't have.
Yeah, they're
funded
fully funded.
big level.
In that
Right.
bottom table, that middle row is important.
Which page number, I'm sorry, guys?
You're on page 16.
16.
Got it, okay.
That 100%, 112%, and then look who's. I mean,
Waterbury.
but I love this because it just shows you that there's not one right answer. Because look at Bristol.
Yeah.
Right, they got 10% in private equity, 9% in real estate, 20% in hedge funds. So there's 40%.
Josh, do you know if they have somebody like you managing their, what explains Bristol? Do you know?
I
They've done a hell of a job.
don't know who manages the.
You guys are fired. We'll take whoever's doing them.
No, they're going to get us there. They're going to get us to 127%.
I wanted to revisit one question Ken had there, on the additive nature of private equity. I just want to bring up your experience on the pension fund. Over 5 years, your equity portfolio has returned 14.6%, your private equity portfolio 18%.
What
On a
percent?
18, so that's 3.5%.
1.8.
1.8.
And equity is 14.
Right.
14.5, yeah. 7-year basis, that's 11.5 on the equity side, 17.2 on the private equity side. And on a 10-year
That's
You compound that.
Oh, it's huge. It's massive.
Yeah.
and on a 10-year basis, it's 10.5 on equities, 16.8 on private equity. Just as a reminder, over the last 4 years, you've been allocated to the 3 HarborVest funds that are kind of in their early investment stage. They've had some nice realization on a couple of secondaries and co-investments that they've had in their funds, but it has not been a gangbuster year over the last couple of years for the private equity asset class as a whole, just kind of as rates rose and how much GPs are kind of delaying some of the distributions. But still, the actual experience, and I know past performance is not guarantee a future return, but
No, but it's interesting. Yeah.
this is kind of the basis of kind of not just our, the CMAs kind of building in the fact that there has been this kind of equity premium, if you will, or private equity premium above global equities.
How much, out of curiosity, we have a sweet fee deal with those guys. How much of that performance do you think is related to the better fee deal we have?
I don't know. I mean, all of these are net of fees. I mean, HarborVest
fees.
management fee is lower, but it's not all that different. It's not substantial.
Right. No,
crazy.
Yeah,
the management fees
it's a
on the
question.
other.
I don't know the answer.
Yeah. I mean, certainly fees impacts all of this, but I think that there have been strong periods of private equity very much outperforming, and there's a reason that big institutional investors use the asset class. It's not just access to markets that are not public. Companies are staying private longer, but it's also historic performance, and
that's helpful. Yeah.
I would say we've done stats on the PE funds that you're in, and they're not all top decile or top quartile, right? Most of them are either first or second quartile. So you're looking kind of in the 20th to 40th percentile of funds, and the performance relative to indexed public equities. Right? I know that there was some active public equities in the very historic, but just kind of the broad global equity.
That's
performance is substantial.
Helpful. I just want to add one other thing to everybody here. I think human nature is that people like to change, right? I just want to make clear that Josh, to his credit, and Ray have repeatedly said that there's nothing fundamentally wrong with what we have, number one. And I'd also say that choosing to stay with what we have is also a choice. Yeah. So I'm just pointing that out, that it's not like we came here tonight with some sort of mission to change. We just want to make the best choice that we're comfortable with.
That's why I've been asking these questions. I'm like,
which could include staying where
marginally different. Like, why? What make me change? Like, why should we change? Like, can you convince me of it?
Yeah. I'll just go back to some. I think we've all been saying variations of the same thing, and I use the term high conviction, but I think Ken, you said median or better. Tom and Nick have weighed in with similar language. I think the question, Josh, for you and Ray is, why should we, I mean this in a very collegial way, why should we feel that the recommendation you give for the actual manager, the selection of the manager and the monitoring of the manager over time will result in median or better outcomes over time? And it's not meant to be a difficult challenge. It's just it's a question. It's I understand you guys have a large number of people doing this analysis. You've spoken to us on the PE side about areas of expertise. Is there anything else you can add that will get us over the hump on, hey, we're going to get, there are no guarantees in life, but we can be reasonably comfortable that over time, to use expression, we'll do average across the alternatives?
I mean, I think, look, BlackRock has a very long track record. Ray, correct me here on, maybe I won't say how far back it goes because I want to say 99, but that might be a wrong date here. But, we could certainly recirculate the information. I don't think we had too much on BlackRock private equity per se in that more educational materials, but we can definitely have the PE team come in and talk to you about get very granular on what their selection process is, run through their track record, because they are above median in terms of being able to select those managers within funds for institutional investors. So there is that long track record. Again, past performance doesn't necessarily guarantee future outcomes, but they've been doing it for a very long time. They have a deep team of people who are both industry focused. So that's not financial industry, but industry that you're investing in focused, and they have deep relationships with a lot of the top PE managers. So they have an ability to kind of direct and have some control over how they're allocating their money.
Yeah, and it's not a set it and forget it, right? It's, I think we talked about, like, it's a constant monitoring, constant due diligence on all these managers, making sure they have relationships with all those GPs out there, and watching for signs of deviation from their current strategy.
If I could
Do you
just
guys
give you a perception from the field, if you will. My perception of BlackRock is that you guys, Aladdin is a great product. Your fixed income reputation is strong. Your equity fund management reputation is so-so. It's not a great reputation. This is just my perception of reputation, by the way. And I have to say, I have no idea about really in the market what your reputation is for manager selection. So if there's any way to kind of flesh that out, like, hey, here's where we're really good. Here's where we're newer to the field. Here's where our results haven't been great. I mean, if there's any objective way of saying this is why you should be comfortable with our ability as an OCIO to evaluate managers and why you should proceed with alternatives. And like I said, it's not meant to be a difficult challenge. It's not meant to be an impolite challenge. It's just meant to be a question. Across the range of things that you do, manager selection to me is not well known. Can you just flesh that out for us?
Yeah, I mean, I think it would probably make sense to have Annie join a JRIB meeting again to do a much more deep dive focus, right? When we brought Annie and our private equity team in June, it was much more broad asset class level, kind of what is private equity and why do you want to invest in it? We can certainly have a much deeper focus on BlackRock actually managing private equity.
At the risk of being an outlier, I found that the presentation, there's no point to beating around the bush. I found the presentation to be a little salesy. So I would love to hear a hard hitting, here's where we're strong, here's where we're not as strong, and here's why type of presentation. And no sales, no fluff, just, hardcore metrics to the extent that objective third-party metrics can be cited, that kind of thing.
Sure.
And again, I mean that with I mean that with a lot of respect, by the way.
My strengths are my weaknesses.
Yeah, right, yeah.
I know you updated some of the presentation to have option D. In the December materials on page 30, you have the comparing outcomes of like your future asset values, where you try to put in like the different percentiles of performance of here we have, current A, B, and C. Do you know if you have this updated for D, or could you make it? Because, I know everything we're looking at here is projections, but this is maybe one thing that starting to, I kind of weigh the pros and cons. And if you look at this slide, okay, long-term 50th percentile, they're all about the same, right? There's not a lot of difference. Not a lot of difference at 25th percentile or 10th percentile. They're all kind of the same. So like the downside is similar. So if I'm looking at a couple options where I'm like, you know what, in bad cases, everything's going to look pretty much the same, but when we actually get it right, or they do a good job and you hit the 75th percentile or the 90th, then that's really like I'm getting the opportunity for outperformance with the same downside. I would like to see this with D, and then I think this is something that maybe is helping me kind of lean one way or the other.
Wouldn't that just be adding volatility though? I'm just curious. I mean, so you're at the 75th or 90th percentile with higher volatility, so you're going to have better results.
It looks like 50th, 75th, but
I understand.
And we asked for the other materials updated with D. And so
it's
going to be. I mean, honestly,
yeah,
the NAV is going to be up there at probably $4 billion for that one at the end.
Yeah, we do have the summary of projected outcomes. We do have that run with option D, and we can send that around.
If it's in here, I missed it then.
It's not. No, it's not
Oh,
in
okay.
here. We had it as a side. The initial kind of follow-up ask was just the stress test, but we did run these. I can get those to Calvin to pass around, or I'll just email directly to everyone on those stats. I think, your perception, Nick, is definitely right on the downside, right? The downside, especially on the funded ratio side, looks all the same, but that's because you're paying for that outcome, right? That's where, things didn't go well. So you make contributions. You almost want to align that with like a 75th or 90th percentile in terms of contributions, because you're putting that money in. And that's where, option B and C in the near term is a bit lower. Again, like the distribution here, and you're right. I don't think that there's a ton of additional spread that you're going to see. The differences in returns is, 20 basis points. Volatilities are about the same. So, within the belly, the 25th to 75th percentile outcomes, you're probably not going to see a ton of huge dispersion. Where you do see that outcome is on the NAV chart, which is page 30, for example, because you're right. The greater the return and the higher upside that you eventually get, there's just a lot more upside in the portfolios that have higher returns.
Let me say something. I promised Tom Harris we'll never have a meeting that goes too late. I think we're reaching a point in the evening where, given we've had some new questions, Nick, and at least it seems to me that the only thing I think I can say with a certain amount of certainty and consensus is that nobody here seems to think that anything leaps out at us as being an obvious decision, right? We just must do X, Y, or Z. And I also think that most people around the table, including BlackRock, to their credit, by the way, Josh, to his credit, has never said anything other than our current portfolio is perfectly okay. We may or may not want to tweak it, but if we chose not to, they wouldn't lose a lot of sleep over it. So I think it's pretty clear that we're not going to be voting to make any big changes tonight. So I would, in the spirit of the holidays, recommend that unless there's any other questions that we'd like to leave with BlackRock, which everybody at the table is welcome to fire away, I would say that we probably should table this. And again, table it, importantly, not like we're tabling it with a crappy portfolio. We're tabling it with something that's done very well and isn't really tremendously different than anything we're going to end up choosing, even if we make some changes. So this concern.
And we have some follow-up for you on the PE side that
Yes,
Tom
that's
brought
right.
up also. So we want to make sure we follow up on that.
Tom Collmore had some questions that I think are fair, and maybe other people felt the same way, get a little more comfortable with how these products are selected and chosen and monitored and so forth. So
Could I make a suggestion, Ken?
Yeah.
And everybody, I think at this point we've left our colleagues at BlackRock with at least 3 requests. Would it make sense, Josh and Ray, to recap the requests we've made of you and make sure that we have a consensus that those are the questions and requests that we've made? Because it seems like we're leaving a lot of stuff on your table.
Yes. I have follow-up in the stochastic simulations, adding option D. It's not just the stress tests. We'll add the option D to the simulation summaries tab or page. We'll get that. There's kind of the direct ask on not just PE track record, but kind of what has been the but not just the process, but the performance of manager selection. And there also was maybe an ask on a case study from that stake where there was a P manager that lost favor with the team and continued to be bad.
Yeah, that was my question. Don't bother. I mean, it won't be hard to find one case. I meant it as a generic comment where you guys could prove to us that this special skill has worked.
What did they say? I forget how many managers or deals they said they look at a year, but there's a ton they don't invest in.
I hope so.
I mean,
Well, at the risk of being difficult, I think it's actually a really good request. I mean, I think even anecdotally, a manager that you guys were close to, maybe you can't mention him by name, but just say, I'm not saying you can't, but maybe you can.
Jeffries, first grade.
And just basically, hey, we worked with them closely. We had umpteen billion of dollars managed by them, but our client money with them, and we left because of X, Y, and Z. And I think a war story actually could be illustrative, but just it's your call. If that's a way to illustrate objectivity and skill, I think that's fair.
We received an anecdote on that last meeting relating to performance in the Japanese markets, I think. So I'm not sure. I don't know.
I'm not pulling rank, Tom, but I think that would actually be less than helpful, personally, because it would tell us something worthless, but it might make us feel good. And
well, okay. Then Ken, I hear you. I would make an open-ended request. That the point is, and leave it to BlackRock to determine how to do this, to demonstrate that you are being selective, you have the skill to select, and you have the skill to deselect managers. And
yeah, I agree with that part.
Yeah, however that is. I don't mean to put words in your mouth or to prescribe a particular approach, but to actually make that point.
Okay. Anybody else have any other requests for them to report back to us next meeting? Okay.
Maybe you can let us know if we actually increase, let's say we went with D and, okay, all of a sudden we have real estate, private credit, infrastructure. How are those are they just going to be invested, in like BlackRock funds that you guys are doing direct deals in, or are they being put into like BlackRock fund of funds where you're actually picking other managers? That would be good to know. Like, what type of is it? Yeah, is it direct or fund of funds? Kind of that would fit.
Or option C. I mean, they are our fiduciary advisor. We don't necessarily have to be in BlackRock products.
Yeah. So we have.
Well, if it was a fund of, they're going to be picking other. Either they're going to take that money and they're going to direct deals,
right,
or they're going to have some type of fund of funds where they're going to. Yeah, what is their fund of funds or somebody else's fund of funds?
There are other fund of funds.
Is it going to be a fund of funds? I hope not.
No, there's no.
Or you're paying them a fee, right?
Right? You would be.
Private infrastructure, private credit.
You don't have to answer that now. That could be a follow-up.
Yeah. No, I mean, look, we have BlackRock. We have third-party managers that we use for all of these asset classes.
Okay.
Some of these asset classes are BlackRock fund of funds as well that are not a BlackRock fund. It's a BlackRock fund, but it's all third-party managers that we're allocating to.
Yeah.
What we would do is, if there were allocations to all of these asset classes, we'd probably try and look at a alternatives portfolio holistically and decide how we're going to make initial commitments, whether it's primaries or secondaries or co-investment across, that's generally a private equity and private infrastructure element. And then what is the kind of asset class of need in the private credit space, whether that's direct lending or opportunistic. We'd probably want to just look holistically at the overall risk of the whole alternatives portfolio, and then we would allocate to managers that way. It'd be part of a broader pacing study, something that, I know we have 10 meetings next year, so there will be something to think about filling up content, but there is, going to be need of updating, pacing analysis overall, just kind of when do new commitments need to be made if no changes to the asset allocation get made. So within that type of illustration, if there were additional private market asset classes, the pacing would take into account all of those exposures and kind of how you're accessing all of these markets and find the right mix and then the right managers within those mixes.
Okay.
No more questions for me.
Okay. I'm going to move on to the next topic. Thanks, Josh and Ray. I mean it. How's sunny California? Nice and warm?
It's been cold. I mean, by cold, I mean 65. So
Yeah, I saw that coming a mile away. Let's see, hang on one second here, I apologize.
It's the circulation and contact lists item for new business.
Okay, please tell me what you're talking about.
Under new business, we have circulation/contact lists with signing authority and authorization permissions denoted.
Okay, so I think I know what this was Tom, right?
Yep.
I do think it would be helpful, and Calvin, you can do this easily. There should be a roster that everybody has with everybody's name, email, and phone number on these boards, right?
I can create that, sure.
I know you can. So I think we want to do that. List with signing authority, I guess that's going to be something Tom and I will talk about, right, Tom?
Yep.
Because it is a fair point. I know we've had some situations where Carolyn was still listed as a signer, et cetera, et cetera. So we do want to clean all that up, but
And I wasn't.
and you weren't, right? So we will, we can work on that here. Tom, is that what you were referring to?
It was signing authority, yeah, where Carolyn and I were the only two people apparently authorized to sign
Right.
something. And
Right.
I just think we should all, I don't know if FOIA, governance issues will intrude on this, but absent that, I would think we should have a central place where everybody knows who's on the board, who's
Yep.
able to sign, for
Mhm.
what it's worth, who's the chair, who's the vice chair, who's the secretary. I think all, and by the way, this goes back to the meeting we had relatively recently where not all of us got the information at the same time. I think
Right.
having addresses readily available will accelerate the distribution of
Yeah,
documents.
no, 100% agree, and thank you. And I just want to, I'm sorry, anything else on this? Just one thing on new business. I'll call it new business. It's not really business, but,
That's something we have to vote for it.
say again?
There has to be a 2/3 vote to add something to new business.
Well, isn't new, oh, okay. Well, how about I just want to talk about something?
If it's like a broader item, you should probably vote on it.
It's just a comment.
Oh, okay, then go for it.
Oh, okay. I'm a very polite person. I'm not going to. So one thing I want to just tell everybody on the board, which I think is important. I've been making a little bit of a mission myself, and I've been working with Tom on this, that, and I think this goes not just for the JRIB, but for all volunteer boards around town, but that's beyond my purview, that we remember that we are volunteer board members here, okay? Meaning, everybody here, I think, is hardworking with good intention. I think we're often receiving communications and things that are outside of our responsibility. Recently, not to criticize, Nick was, I think, trying to be responsible and helpful, and I thought he was getting involved in something that was just so far beyond anything he should be working on. If we get, anybody on the board gets a communication from an employee or a vendor or, anything, that should be immediately forwarded to, I'll just say Calvin and Tom, okay? There is no reason, in my opinion, I'll just use an analogy, I was thinking about this. If you're on the TP&Z and you've approved a new building, you shouldn't be discussing with the builder the percentage of concrete and sand that's going to be in the pilings or something. In other words, I just think that volunteer board members, I'm speaking for the JRIB, but I think across town, should have their responsibilities extremely narrowly tailored. That's my opinion. And I just find I've gotten a lot of things that I don't think are appropriate. I know you just got one I think was not appropriate. You didn't do anything wrong.
No, send it to the lawyer.
No, I know, but first
we have to do anything.
I know, but first you were trying to be helpful and wondering to do this or that and all. I think it goes right to the lawyer, is my point. Boom.
Well, first somebody, well, I will be clear on this. First somebody asked me, hey, if I want to send a letter, where do I send it? I'm like, here's the link. Not knowing what the
I'm
letter
not being critical. I'm saying that I just think all of us, I think that, again, I'm being a little over philosophical here. I think in order to draw good people to want to do these jobs for no pay and a lot of time, I think we should be strict. It's an example of why I brought Josh to the Board of Finance at the last meeting. I just think at some point the level of detailed questions were simply becoming overwhelming for me. And I didn't even think I had a good answer half the time. And I just didn't think it was productive. So I brought the professional who we've hired to do this job to help us do that responsibility. So anyway, it's really nothing. It's just, I'm just telling everybody here that your responsibilities are to come to these meetings, to discuss the investments, and to vote on these retirements that we're asked to do. That, to me, is the extent of our responsibility here.
I would like to, well, we were talking briefly before the meeting, like when I came onto the, or when we came onto the board, there's not really like a board member orientation to line all this stuff out or inform us like, hey, if something like this happens, here's the steps that you should go through.
And we've talked about it, to be fair.
Having something even as just like an annual, I don't know, board education.
I think the question, since we have the first selectman here, select woman, first
Select
person.
person.
Select person.
Select person, and for tomorrow, it'll be select person.
Yeah, I'm terribly sorry, first select person. I think the question, to answer your question, would be, is that something we should do for the JRIB? Or is that a good thing to consider town-wide to educate board members across all sorts of boards about what their responsibilities are, what they should do when they're faced
Each
with?
board has, obviously, their responsibility outlined in the charter as an initial guide. So it's not one size fits all. I do think that if there's communication that seems clearly outside of the purview of this board, you should forward it to Tom, forward it to me, copy Calvin, and we can advise you. We want to be responsive. Sometimes the members of the public just don't know where to go. They look to the website, they think that this seems like a good place. These people probably know about it. You know, they have an expertise to be on this board, and we can be responsive to that. There was FOI in terms of just being on a board and in terms of what should be noticed, what you should be discussing. We had training on Monday that all boards, I think, were invited to.
I think there was a video.
And definitely can tune into that. If there's something more specific that this board wants in terms of training, we can
I'm here. It's my job.
definitely make that happen.
Could I ask a question of order, please? I'm just wondering if, as a courtesy to our colleagues at BlackRock, we could invite them to stay. Or
Oh, absolutely, you're right. Yeah, you guys are free to sign off.
Yeah, I'm afraid this is just going. It's a little bit of inside baseball.
Yeah, no, I apologize. I didn't even realize. Sorry about that.
And have a thank you.
Thank
you, guys.
Thank you,
Thank you,
everyone.
guys.
I'll be
And,
back with follow-ups. Have a nice holiday.
Yeah, you guys too.
Likewise.
Okay.
And Josh, thanks for coming to Board of Finance.
oh, of course.
It was nice meeting you. It was nice meeting you.
Very
in
nice to
person.
meet you, and always happy to help Ken out.
Well, it's going to be an annual affair, so.
He doesn't have to come in.
Looking forward to it. All right, well, take care, everyone. Thank you.
Take care.
Thank
Are those meetings,
Happy holiday.
how often does I probably should know this,
It's must-see TV. It happens
but
quite often.
how often does Board of Finance meet?
Too often.
These are the quarterly meetings.
You quarterly.
Right.
I'm just like,
They
we should
meet
start
at
like,
least-
tuning into
They
those.
meet, they have monthly meetings and then there are quarterly meetings.
Yeah.
And sometimes special meetings and subcommittee meetings.
Other than that, they
And
barely
budget.
meet.
And budget meetings, so it's,
Don't they meet, right?
They don't meet in the summer.
Right,
so if you have a free night and want to go to a meeting.
Exactly.
There'll be one.
Sparks fly. They're good fun to
yeah,
watch.
they can go.
Not to go late.
Okay, any other matters at hand that they'd like to bring up? Okay, anybody want to make a motion to adjourn?
I move to adjourn.
Oh my goodness.
Second.
Yeah. Okay, all in favor? Aye. Opposed? Okay, thank you, everybody. Merry Christmas, Happy New Year.
Good night.